All right. Earnings per share. Today we're doing diluted earnings per share. Last week we started with earnings per share, plain basic earnings per share. Not plain, it's called basic earnings per share. And when we do diluted earnings per share, that is what we start with. We start with basic profit and basic number of shares from our basic earnings per share calc. Yeah, from last week's calc, whatever we had got for basic profit and basic number of shares. And remember last week we did some adjustments for preference dividends, isn't it? And we made some adjustments when we had participating prefs. And then we also made adjustments to the weighted average number of shares, if we had share issues or cap issues or rights issues. And that number is the number that we start with when we do diluted earnings per share. What is diluted earnings per share? Diluted earnings per share exists when there are potential ordinary shares in issue which could become shares at a future date for no or less than consideration, or no or less than the fair consideration. So what are examples of these potential ordinary shares? We're going to look at 2, 3, 4, I think 6 different examples. The first one is convertible pref shares. Convertible preference shares are preference shares that could convert and become ordinary shares, isn't it? When they become ordinary shares, there won't be any more money coming to the company because the company already received the money when they issued preference shares. The second one we're going to look at is convertible debentures. The company issued debentures which are convertible. Those convertible debentures, when they convert to shares at some later date, will dilute earnings per share for no extra value. The same pie is going to be given out to more people. We're also going to look at share options. The company might have issued options to employees for performance, for example, isn't it? Or and those share options are exercised usually below fair value, isn't it? That's why they are a remuneration method. So those ones are potential ordinary shares. I've already given you the options. They're exercisable in 10 years' time or 5 years' time. We're also going to look at contingently issuable shares. I'm going to just say contingent, not contingently issuable. Contingent shares are shares that are given for free. They're given sometimes to management, sometimes to customers. If you could say to a customer of yours, if you buy more than a certain amount of volume from me this year, I'll give you a couple of shares in the company, isn't it? Or you say to management, if we achieve a targeted share price, you'll get so many shares. Yeah? Contingent shares, they're dependent on an uncertain future event, a contingent event that will occur. We also have what we call written put options, and I'll explain to you what those are. But put options, you know all about options, huh? A put option is an option to sell. A call option is an option to buy. That's the names for the options, call and put. So a put option is an option to sell. It's an option that a shareholder has to sell his shares back to the company. And that will cause a dilution of shares, and I'll explain to you how that will cause a dilution of shares. And lastly, we're going to look at deferred shares. Deferred shares are shares that are not currently sharing in profits. They are shares where there's a deferred payment of dividends. So shares that are currently not sharing in profits, they only will share in profits at a later date. And so therefore they affect your current earnings per share and will affect your future earnings per share. Hey? deferred shares. So these examples are all in your study guide, and we're going to look at them one by one. But in essence, the diluted earnings per share calc basically says start with basic profit and basic number of shares, and then just ask yourself one question. If that instrument became shares today, what impact would there be on those numbers? So what is the adjustment to profit if my convertible prefs become shares? I won't pay a dividend anymore, isn't it? Do you remember that to get to basic, I removed a preference dividend? I will say to myself, what if those shares were ordinary shares? I wouldn't have that preference dividend, isn't it? So profit would go up. Do you agree? And then I would ask myself, how would it affect number of shares? Well, if I have pref shares that are converting to shares, then the number of shares will also go up, isn't it? And that's diluted earnings per share. That's all it is. We take the basic and then we say, if that instrument was already shares, what impact would it have on profit? What impact would it have on number of shares? So you can immediately see that prefs and debentures is dividend savings, interest savings after tax, number of shares going up. Share options doesn't have an impact on profit, not anyway at this stage, but it will have an impact on number of shares going up, isn't it? Written put options, number of shares goes up. Contingent, number of shares goes up, isn't it? That's basically what all of those are. But we're going to look at the examples one by one, and we're going to start off with an example that looks at pref shares. Yeah? The example for pref shares is in your books. It's example 20. There are millions of examples in this module. I think last year's guide, so mine was 158. I think I'm about 2 pages. I'll check around page 160. 159. Okay, so it says the company currently has 2 million shares in issue. Basic earnings for the year was this. So this is where I'm going to start my calc. Do you agree? I'm going to start with earnings of 1850 and profit and number of shares of 2 million. Then it says I have 100,000, 15% cumulative shares amounting to R1,000,000. The dividend is always based on the rands for a pref share. Yeah, 15% on the million is 150,000. They are cumulative, so it didn't actually matter whether I'd paid the dividend or not paid the dividend. I would have adjusted that 150 in this number. Do you agree? So now I'm going to add it on. And it says that they are convertible into 4 shares for every pref. So this is going to convert times 4. It will convert into 400,000 shares plus the 2 million odds that I currently have in issue will give me a total of 4 million shares. 24 jeepers. I keep putting in hands. 2400 and profit 2 million. So there I could put the rands. I don't, and there I kept wanting to put the rands. So basic earnings per share 1850 divided by 2 million, 93 cents. Diluted earnings per share 2 million rand over 2.4 million shares, 83 cents. You can see that there is a dilution, isn't it? If those pref shares had converted, the earnings per share would only be 83 cents. It wouldn't be 93 cents. Yeah. So diluted earnings per share is 83 cents. I don't know why they say they're 84. Let me see if that's the calculation. Yeah. Easy enough. Okay. With debentures, I just want to touch on debentures quickly. Because for convertible debentures, they have a simple example and they have a more complicated example. But in essence, if I start with basic profit, I have basic number of shares. For convertible debentures, I will be adding back the interest after tax. Because do you agree my numbers are all after tax? if the debentures convert, I save myself interest, but I also lose a tax deduction, isn't it? So I will add back interest after tax, and it's the interest saving. I will save interest after tax. It's a saving. And at the bottom, I will add back the converted shares. Now, it looks easy, and you might be wondering, why is she putting that on? Because it sounds exactly the same as what I had for prefs. How many of you have not done FAC3702? Okay, now brace yourselves. Do you remember compound instruments? Compound instruments. Convertible debentures are compound instruments. Yeah? So convertible debentures, if you remember from 3702, we had a liability component and we had an equity component. Do you remember that? And what we did is that the liability component, we did an amort to work out the interest. Do you remember that? So the interest that lands up in my P&L, if I'm accounting for the convertible debenture correctly, is actually this number. It's not a straightforward number. Agreed? We have to be able to do that. But now, usually, sometimes, they give you the sum of the amort, or they give you the split, the initial split, just to help you along. But you do kind of need to understand what that was, isn't it? And you remember it now, I'm sure, vaguely from FAC 3702, that convertible debentures have a liability component and an equity component. The equity component doesn't move, it stays flat. The liability component moves, it gets amortized, isn't it? And that's where the interest comes from. All right. So they have two examples. The first one is 21, which is the one that you have immediately following the previous example, 20. And they say that the company has ordinary shares, 4 million of them, and they have cumulative prefs, 500,000. And on the 1st of September 06, that was last year, they issued 2 million debentures of 2 million rand, bearing interest at 7%. They may be converted into ordinary shares at 1 rand per share. So it'll be equal. Do you agree? Equal number. They said the profit for the period was 550 and 450, and there was an ordinary dividend that was paid. So my first step is to work out basic. There are some cumulative prefs for 10% ones. So my basic profit, my first step, which is to work out basic, is to actually adjust it for that cumulative dividend, that pref dividend of 50, the 10%. And I will take both years. That year was 450, I adjust it by 50, I land on 400. 550, I adjust by 50, I land on 500. There was no change in the number of shares, and I have my earnings per share, 10 cents and 13 cents. Yeah. Now, these are the numbers I'm going to use to do my diluted. I'm going to use those numbers and these numbers, and I'm going to adjust now. Okay. So, the first calculation that I adjust is for the debenture interest. The debenture interest is after tax, remember I said to you? And so a basic adjustment would just be this, 2 million rand, 7% debentures, times 72% to get it to after tax. Yeah? And so I start with my 500, and there's the number. 2 million, I will save interest of 7%, but I will lose tax of 28, so I times by 72. The previous year, I had issued the debentures in September, so I must wait it. Hey, it wasn't there the whole year. September, October, November, December, for 4 months, I must wait it. And so therefore, you see that in that one, there's an adjustment for 4 months. And from there to there, I'm only doing 4 months. Yeah? There's obviously a weighting in the year that you issue the instrument, not in the year that you don't worry about when it converts or doesn't convert for your purposes. In honors, we will see a little bit of adjustments with that, but we will weight it in the year that the instrument was issued, which in this case was in our prior year comparative. Then, for the conversion, for the number of shares, I start with 4, my adjustment is 2, I land on 6. Yeah? For the current year, that's what the numbers are. I start on 4, I add 2, and I land on 6. But for the prior year, again, I weighted it up there. There's a weighting over here, again for the 4 months. Yeah, because I only issued them 4 months into the year. So there's again a weighting for the 4 months. So diluted earnings per share then, if I just look at current year, which doesn't have any weightings or anything, 6 million shares. If I had to convert the debentures, profit would have gone up to 600, 800 if I hadn't converted the debentures. Diluted earnings per share, 10 cents. Basic earnings per share, I think, was 13 cents or something like that. Yeah. For the comparative, I have only brought in interest for the 4 months, and I've weighted the shares for 4 months, and they get 9 cents. Remember, I said to you last week, I think, that this is the one section of work where they do sometimes like to ask you the comparatives, and so they will ask you in the question, they will give you the information to do it, and then in the question they won't necessarily ask you to do it, but they won't say don't do it. I'm sure you've started to realize in third year especially, the requireds will say ignore comparatives, isn't it? That's because IAS 1 says you must do comparatives. So if they ask you to comply with IFRS, you should be doing comparatives. But for this one, they sometimes give you the prior year's information because they want to see 2 years worth of dividends. All right, so that was the easy one. But then if you move to example 24, which is a bit later, I think there's another example in between. There's share options or something in between. So if you example 24, we then find these convertible debentures that we're going to account for as compound instruments. So let me just take you through the steps of that calculation so that you can do it in case in an exam they do expect you to be able to do it. But you anyway want to be able to do it because you want to be able to amort it from your calculator, not be doing manual calcs. Do you agree? All right, so C Limited issued 3,000 convertible debentures 1 January 08. One debenture can be converted into 100 shares. So the 3,000 will become 300,000 shares, isn't it? So that piece is easy. We'll see it a little bit later. The debentures not converted will be redeemed at par. When, and that's important as well, when they're not converted, they will be redeemed in cash. When the debentures were issued, a prevailing rate for similar debt without conversion was 15%. We're going to work out the present value of the liability by looking at the cash that will be paid at the market rate for similar debt with no conversion. Yeah, so if we look at that cash that will be paid, they were 11% debentures, so the payment is 11% of 300,000. Do you agree? The future value will be 300,000, because if they don't redeem, we will pay them in cash. N will be 3, 8, 9, 10. Yeah? I work to the first year end. First year end December 8, December 8, December 9, December 10. 3 years. I is the market I for similar debt with no conversion. And then I work out a PV. So if you do that for me, you will work out a PV. And then you'll be able to amort. I just want to see what year end we're at. We're at December 9. So we're in year 2. Do you agree we're in year 2? So on your calculator, once you've done that, I want you to amort. And I want you to give me interest year 2. And then I want you to after tax it for me, because those are the steps you need to be able to do. So I want you to amort it and give me interest, to give me interest year 2, and to give me an after tax. also do it. You should have got that number. They have it there for you. 2702601. Oh, after tax. Before? Okay, I've got 42074, 42073, 074. Let me put the number that I got. So that then when I carry on with my calcs, they work. $32.93. Is that what you say you got? Do you remember how to amort? Oh, I'm seeing ugly faces. No. You've got, once you have your PV on those shops, it's I think 0, you've got a Texas. Is it? Oh, it's a scientific one. Do you have a financial one? Yeah, you need to bring it. Once you have it, it's 0N, 1N amort.
Only use 3 years.
You're going to do it manually.
How do you
You remember how to amort? Come and we'll show you quickly how to amort. HP?
Yeah.
Come and we'll show you. Do you remember how to amort, Sonia? Do you want Sonia to quickly show you how to amort? Ashley?
No.
You can? Okay. All right, so you amort, you just have to be careful what year you're in, isn't it? And then, otherwise you have to do a manual amort. Let's have a look at the solution. Basic earnings per share, 550 over 2 million. Then your dilution, you start with the 550 and you take off the 32, you add the 3293 from your calc. And then on the number of shares, you add the 300,000. Yeah? And you have your diluted earnings per share. Now this, they love to ask this debenture with the compound instrument, because it's a bit more work, isn't it, to actually work out the interest. It's not just the percentage and that's it. It's a bit more work, and we just always have to be careful with what year we're in. And then we sometimes even find a mismatch. So when you're looking at the interest in the P&L for this year, it might be a piece of your year 1 amort and a piece of your year 2 amort. Because this particular debenture, in the example, was issued at the beginning of the year, on the 1st of January, and our year end is December. But if it had been the previous example, the debenture was issued in September, isn't it? And our year end was December. Then if you're looking for the amount of interest that will be in that second year, it will be 8 months of period 1 amort, and then 4 months of period 2 amort, to get the interest that lands up in that P&L. Agreed? Okay. So that's your convertible debenture. And these two are always asked. Convertible prefs, convertible debentures. The third one that is almost always asked is share options. Share options. Now, remember that I'm looking only dilution. I'm only looking for dilution. So therefore, I'm only looking for free options. I'm not looking for options that are paid for. Options that are paid for, I will get cash. And I will use that cash to make profit, isn't it? To buy assets and make profits. I'm only looking for where I'm not getting any more cash. Do you agree with the convertible prefs and debentures? I'm getting no more cash. I've already got the cash. With the share options, I haven't got any cash yet. I will be getting cash, but I won't be getting all the cash. So do you remember the calculation we did last week for the rights issue? And we worked out the free portion and the value portion, isn't it? It's the same for share options. You need to calculate a value portion and a free portion. The free portion is your balancing figure, as it was last week, therefore. How do we work out the free portion and the value and the portion? You use the average market value of shares for the year. When we did rights issues, we used the value or the fair value of shares at the date of the rights issue. Do you remember? But remember, these share options haven't been exercised. We're looking at doing a calculation for a what-if scenario, isn't it? So therefore, what we will use in this case is we will use an average market value for the number of shares to work out how many that would be. So the example is 22, going backwards now. On page 161 I've got, you'll probably have it like on 162, 163, page example 22. We had done 21 and then we skipped forward to 24. Now we're going back to 22. And it says over here for the stock options, 2 million share options were granted to employees on the 30th of June 91. That was, careful here, halfway through the year. Yeah? So this year, I'm going to put a little 6 months. We have to remember that we must 6 month it. It was only issued halfway through the year. The options contain the right to purchase ordinary shares at 50 cents per share before the 30th of June 94. So they've got 3 years to exercise these options. The average fair value was 1 rand. So this one is the easiest one in the world to do because it's exactly half, isn't it? But if I like to do the calc like this, 2 million options at 50 cents is 1 million rand. if I have to pay 1 rand, how many shares can I buy? 1 million, isn't it? I like to work out like logic. 2 million shares, options I've got at 50 cents. I'm going to pay 1 million rand if I exercise the options. With 1 million rand, if I had bought them in the market, I would be able to buy 1,000 options. So therefore, how many are free? The other 1 million. I'm working in thousands, so. But you could see straight away from the numbers here that it was going to be half free, half not free. Do you agree? So when we look at the calc, is it on this page? No, the next page. You'll see they do the basic earnings calc, which they do. They take the Pref div off. I'm going to ignore that. You'll see that when they do the calc, they don't adjust earnings at all. Because there's nothing to adjust earnings by. There's no profit implication of stock options. Not yet. When you get to honours, you will learn about IFRS 2. IFRS 2 is share-based payments. When a company gives its employees stock options, shares, we will account for a value of those shares. And we will account for that as remuneration costs, isn't it? A value of those shares. But because there needs to be a journal entry, we will issue the shares, do you agree? There will be a credit to share capital when you issue those shares. So the debit will be partly the 50 cents that the employee will pay, and partly will be a salary expense, because the employee is giving us a consideration for those shares. He's giving us services. He's working for us for the 3 years, isn't it? So, but you don't know about IFRS 2, so for you, it just sticks earnings. So for you, the only adjustment we would make is the number of shares, and the adjustment that we would make is the 1 million shares. And for the current year, because of the 6-month story, we will only adjust 500,000. Yeah? All right. So predominantly, those are the 3 that get asked all the time. I said to you there were 3 more. I'm going to quickly show you those other 3 examples so you know about them. But you'll see that almost all the questions we see convertible prefs, convertible debentures, and share options. The next one that we have, they have a disclosure here that I can show you. Remember I said to you that there was a note, yeah, which hardly ever gets asked. But here's the disclosure, if you did get asked disclosure. First of all, basic and diluted earnings per share is disclosed at the very bottom of my P&L, right? After total comprehensive income, that's where I show it, yeah? The straight numbers. Then there's the earnings per share note. It's a reconciliation note. And the earnings per share looks to reconcile from the profit that's in the P&L to basic. And then, in this case, it's not applicable, but from basic to diluted. Reconciliation, that shows what I adjusted. And for denominators, the same thing for number of shares. It's a reconciliation from the weighted average used for basic to the weighted average used for diluted. So basically, it's what you do in your calc, isn't it? You're just going to disclose it here. Okay. The next one that I have to show you is the contingently issuable shares. Maybe I can do a quick little spiel. The contingent shares are dependent on this future event happening, isn't it? So imagine that I have given shares to management. And I've said to management, in 3 years' time, if the share price is a certain amount, 100 Rand, they will get shares. Yeah? Do you agree it's a potential dilution, a potential shares? And so I would need to account for it in my diluted earnings per share, isn't it? So the rule for contingent shares is this. If the contingency would be met, I include. If it would not be met, and I think I should say there would be met, so if a year end comes and the share price at that year end is 101 Rand, then it shows me that that contingent would have been met by that year end, and I include that number of shares into the diluted calc. Yeah? If the contingency would not be met, I don't include it. If the next year end comes, and in the next year end the share price has dropped to 90 Rand, then I don't include it. Because I'm at year end, I'm saying, would there have been extra shares at this year end? And the answer would be no, isn't it? By the time you get to the third year, contingency is met. Definitely met. Maybe you haven't even issued the shares yet, but the contingency is met. Then we include it in basic. It's no longer diluted. It's no longer a potential ordinary share. It is a share. It just happens to be one you haven't issued yet, isn't it? So if they said to you in the third year, this could even be your scenarios for year 1, year 2, and year 3, isn't it? So it could be that they said to you, in 3 years' time, you'll get, if the share price is 100 Rand, you'll get some shares. In year 1, at the end of year 1, the share price is 101. We include it in diluted. In 2 years' time, we would have issued the shares. In year 2, it's 90 Rand. Now we won't include it, because in a year's time, we won't be issuing the shares if it's 90 Rand. Year 3 comes, and the share price at year 3 is 110 Rand. Now, the condition's met, isn't it? We're going to give them the shares. It's no longer even diluted. Now it's basic. Yeah? Those shares are not potential shares. They're actual shares. You just haven't issued them yet. So they will dilute your earnings per share. It's not even a question that they might. Okay. The example, I think, is almost identical to this one. But I've seen one also where it's a customer and it's based on volumes of sales and not on share price. So they say the company has a 30 junior Rand. It entered into an agreement with senior management. They will give them 30,000 shares if the market price exceeds 3 Rand on the 30th of June, 2009. The market price of the shares at the following date. No, those dates must be wrong, right? Anyway. Because how can they give us 1911 if that was 09? I don't think so. So let's assume that that date's not right. So if the share price exceeds 3 Rand, we will do it. Right? So if we look, the first year end, the share price exceeds 3 Rand, we'll include it in the diluted. And we'll include 17,500 shares because it's only been in issue for 7 months in that first year. The agreement with the shareholders was entered into on the 1st of December. So by the time we get to June, it's been 7 months. So in that first year, we will include it, but we will only include it for 7 months. In the second year, we will not include it because it doesn't exceed 3 Rand. And in the third year, it exceeds 3 Rand. And you'll see here, we don't talk about including it in diluted. We just talk about including it in the weighted average number of shares because now it's going to go into basic. But this one I've never ever seen in an exam. But it's also easy if it is there, isn't it? So the rule is, I have a contingency that is or is not, or would not have been met at year end if the time had come. If it's in, it's not. If it has been, it's in. If it hasn't been, it's not in. Okay. The next one I have are written put options. I must draw you a little picture. So here's the company. Here's the shareholder. In order to encourage this shareholder to take shares, what the company did is it gave the shareholder an option. This shareholder has the option to sell back his shares to the company. At a fixed price, Rand X. It's called a written put option. You can't barely read my scribbles because this company is underwriting the option. They've written the option, isn't it? And it's a put option because a put option is an option to sell. They've underwritten an option that they've given to this shareholder, which gives this shareholder the option to sell his shares back to the company. The assumption we make with these written put options is that the company will have to issue shares to raise cash to pay for the exercising of the option. When this shareholder comes and he says, we have an agreement, you were going to pay me 100 Rand a share, I want to sell my shares back. Now the shares are only trading at 50 Rand a share. I have to sell twice as many shares in the market to raise the money to pay him back for the shares he's going to give me. Do you agree? That's a written put option. Now, the examples are there in the study guide. I've also never seen one in an exam question. It's not to say, I suppose, that it can't be done. Let's have a look. Okay, so the assumption is that the company will issue shares to raise the cash that it needs to pay for the exercising of this option that the shareholder has chosen to exercise. We're looking at the next example. It's 25. Why do I think we've seen a 25 already? Or did we see a 24? Okay. We're now on 25. An entity has 200 written put options to ordinary shares. You know what it means now, isn't it? If I said to you, it's written put options, you go, what? Now you know. What it means is that there are shareholders out there who have the option to come back to the company and say, here we go, I want to sell you my shares, and you have to pay me 65 Rand. Thank you very much. The average market price of the shares for the year is 50 Rand. The company will issue ordinary shares to finance them back. We always will look to see if the shares are in the money. Yeah? Do you agree that if the market price was 100 Rand, is that shareholder going to come to you and say, please buy back my shares for 65 Rand? He won't, isn't it? We're only looking for bad news from the company's perspective, not good news. So if the share price is 100 Rand, that shareholder will not come to you to sell you his shares for 65. He'll go sell them for 100 in the market. So we will only ever see this if it's bad news. So the average market price is 50 Rand, which means that in order for us to pay back the 65, I'm going to have to issue more shares. Do you agree? So here's what I need. I need for 200 shares at 65 Rand, 13,000 Rand. Agreed? It hasn't happened yet, but the options are in the money, which means a shareholder can make money by exercising that option. Yeah. The number of shares that I need to issue is divided by 50 Rand, isn't it? 260 shares. So this is what will happen to my weighted average number of shares. My weighted average number of shares will go up by 260 because those will be the shares I will issue in the market, and they will come down by the 200 because those are the ones I'm buying back from the shareholders. And there will be a net increase in shares of 60. Yeah? Written put options. So if you just remember that assumption, the shareholder will come to me, I'm going to have to buy his shares back from him. In order to raise that cash, I have to issue shares in the market. So there'll be two movements in weighted average number of shares. I will issue shares, shares will go up. I'll buy back shares, shares will come down. All right, there's one more left, which is the deferred, no, what is this now? A sequence of dilution first. Yeah, this is the deferred share over here. Let's do the sequence of let's do the deferred share. Page 27. I already sort of touched on what deferred shares. Look, I was going to write deferred tax. Phew, it's amazing how your brain thinks without you, hey? It was like just my hand was just writing deferred, and I was thinking deferred shares. But my brain was going, no, you mean deferred tax. And I'm writing in red, which I always like to use when I do tax. Okay, deferred shares. Deferred shares are shares that will only share in profits and dividends later. And so because they share in dividends later, then it means that at a later stage, my shareholders that don't have deferred shares, their earnings per share will drop, isn't it? I have seen one past exam question that had deferred shares in it. Let's look at an example. So, they have the following shares. They have odds, cumulative prefs, and deferred. Deferred shares rank with ordinary shares, except they're only entitled to dividends from 1 January 94. And looks like they've been there forever, isn't it? Because look, there's my 2 years, my comparative and my current year, and there's been no movement, isn't it? So it looks like they've been there for a while, but they're only going to share in the dividend from 94 onwards. So if I pay lots of dividends in the meantime, there'll be nothing left for them, isn't it, when that time comes? All right. Do you remember the calculation that we did when we did participating prefs and we had the 2 columns? So this is similar to that. We will have 2 columns. The 2 columns for our basic earnings per share takes my profit, takes off the pref dividend, leaving me with the 500, and then says I will pay 50 of dividends, which only these guys get because those guys aren't getting anything. Yeah, and then what's left will be shared in proportion to the number of shares. If you look at the number of shares, it was 4 million, 2 million. Do you remember? 4 million, 2 million. So they get double what they get. Fair? So when we're looking at earnings per share, then this is my earnings because they get dividend, and then they'll share on a per share basis equally. They won't get the dividend, and then they'll just share on a per share basis. So when we look on 4 million shares, my ordinary shareholders at the moment are getting an earnings per share of 350 divided by 4 million. You're working it out, Carmen? 8 cents. Okay. But once the deferred shares kick in, the picture will look different. Do you agree? So when I do diluted, I don't split it anymore. When I do diluted, I say my profit is 500. It's going to be shared equally among the 6 million shares. And now my diluted, did you get 8 cents, not 8 point something? 8.75, so closer to 9, which is the number they have done here. So they said my initial number was 9, and they were getting 8, but my number after will be 8 for all of them. Yeah. So diluted earnings per share, you do agree, don't get as big a share as the others. Sorry, deferred shares don't get as big a share as the others, because if there's a dividend, they won't get it, isn't it? So when I'm splitting the current year's profits and there's a dividend, they won't get a share of that. They'll just get a share of what's left. If I pay a huge dividend, they'll get nothing, isn't it? Because there's nothing left, and they're only going to get dividends in year 4. All right. So that's deferred. I think I've seen deferred asked once. One exam question. We might come across it. All right. Then I should have put this first, because then we deal with this ugly thing called a sequence of dilution. But before I do sequence of dilution, I'm going to let you practice a bit. So when we look at the assignment, that we started last week, there were some stories here about deferred shares. Yeah? Because remember last week we did basic, but it was such an easy calc. Do you recall? We had this company and we had this company that is looking to explore natural gas in the Karoo or something like that. That's what they say over there. And they, in order to raise money for that, there was something else. In order to fund wind farming, that's what it was, wind farming, they issued 200,000 ordinary shares at 33 Rand a share on the 1st of October. And we had to work backwards, didn't we? Because we were given the number of shares as at March. Do you recall? And we had to weight it. But it was a very simple calc. Okay. We also had not seen any preference shares. There's no preference shares. There was no preference dividend. So there was nothing affecting profit. Do you agree? Okay, so we had done the basic calc. You've got the basic numbers. Those are the ones we'll start with. But then when we look here, we'll see, and last week I asked you to ignore these two paragraphs, we'll see two things. We see convertible debentures, and we see share options. Share options, yeah? What I want you to do for me is I want you to just calculate for me for both of those the adjustments. Just the adjustments. Yeah, so what will I adjust basic profit by for the convertible debentures? What will I adjust weighted average number of shares by for the convertible debentures? And the same for the share options. What will I adjust the number of shares by for the share options? Okay. Let's just see the required again, if what they say about comparatives. But it doesn't look like they've given us any information to do comparatives. Up there it said no comparatives. Here it doesn't say no comparatives. But do we get given profit numbers for the 2 years? No. No, we won't be able to do comparatives, although they don't say, because we don't have profit numbers for the year before. Okay. Let's see if you can. I just want the adjustment number. Yeah. So we had a number from last week for basic profit. We had a number for basic number of shares. And now we're going to make adjustments. We're going to do an adjustment up there for the debentures. And at the bottom, we're going to do an adjustment for the debentures. And we're going to do an adjustment for the share options. I just want those three numbers from you. I'm going to also try and do them. Okay, when you amort, you get a PV of 5,222,467? No? 5,222,467. Your payment is 500, 5%, 12. Your future value is 500 at 12. Your N is 4 from 13 to 17. And your I is 9. So, N is 4, I is 9, future value is 5 12s, which are, is it 6? 6 million. 600. 6 million. And your payment is 5% of that, which is 300. Is that right? Okay. So we work pre-tax there. N is 4. I know when we do debentures in MAC, we work after tax, eh? But when we do debentures in FNAC, we work pre-tax. N is 4, I is 9, future value is 6, payment is 300. You get 5,222 something 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 as your PV. Then we want to amort to year 3 because our year end is March 16. Our year end is March 16. So we want to amort to year 3 because we issue the debentures at March 13. 14 is year 1, 15 is year 2, 16 is year 3. And they were nice, hey? They made the year end match the periods on the debentures. So when you amort year 3, you get interest of 502,003. If you do it manually, you should also get interest of 502,003. Although manually you didn't have a PV to work from, isn't it? So that was a problem. And then after tax it, 361,442. 361,442 would be the adjustment to profit. The adjustment to number of shares is 1 debenture for 1 share. Have I read it correctly? 500,000. And then our share options, I issued them on the first. 1 share for every 2. It's not right. See, I just saw 1. I circled 1, and it's wrong. 1 for every 2, so it's 250. Yes? 250. 1 for every 2. Okay. For the share options, I issued them on the 1st of April 2015, which is again beginning of year, so no waitings there. I issued 300,000 share options to acquire shares with a price of 20 Rand on the 31st of March 18, so in a few years' time. So the shareholders will pay me 6 million Rand. Yeah? They will pay me 6 million Rand. If they had to buy shares in the market, they would have to pay 30 Rand for it, so they would only be able to buy 200, so the other 100 are the free. Or you can just say 300 times 10 over 30, those are the free. Yeah? The 10 Rand difference in price over the market price, those will then end up being the free ones. And that's the ones that we're going to add to our diluted earnings per share. Okay. So it brings me then to the last bit of this lecture, which is called something called sequence of dilution. Sequence of dilution. We want to get, when we do a calculation, the highest maximum diluted earnings per share. So if I just go back here, when we're looking at diluted earnings per share, the aim or the objective is that we want to show our shareholders the maximum dilution. We want to show our shareholders what is the worst case scenario. Yeah? In order to get to maximum dilution, when I have more than one dilutable instrument, and in our question in the assignment, we have 2, yeah, more than one dilutable instrument, we first have to work out the sequence. So when there's more than one dilutable, first do sequence of dilution. Sequence of dilution is highest per share, lowest earnings per share first. So let me show you on the example that they have, and the example is 26. It's a simple example. They have 3 instruments. No, they have 3. They have options, prefs, and a bond. And all they've done is they have first worked out those exact numbers that you've just worked out for the 3. So if we just do them together quickly. 100,000 shares with an exercise price of 60 Rand. Average price is 80 Rand. Do you agree? The free piece is 20 of 80. So it's a quarter of them that are free. So it is 100 times 20 over 80. A quarter is 25. Agree with that number? Then 1 million preference shares entitled to a dividend of 10 Rand a share. My saving over here will be 10 million Rand. It's huge, huh? 10 million Rand. And they will convert into 2 ordinary shares, 2 million shares. convertible bond, a nominal amount of 20 million. Each 200 rand bond is convertible into 20 ordinary shares in 5 years' time. All right, so let's just look at this. Each 200 rand bond, so if the bonds are 200 rand, it means that there's 100,000 of them. They're going to convert into 20 shares. So then 2 million. See, I keep putting rands. So therefore 2 million shares. And then the interest that I'm saving is 10% on 20 million. Therefore 2 million. And after tax times 72%. Agree with the numbers? These ones were straightforward, hey? We didn't have that compound instrument. So in each case, all I'm doing is working out what will happen to shares, what will happen to profit. So these ones were straightforward ones. Something that you would have been able to work out just as quickly as me. So what you see they then do is they put it into a calc to work out our sequence. So there's the 3 options, prefs, and bonds, which is exactly as they were given in the question. And for each one, they've put in the numbers. So this one was going to be no impact on earnings, a 25 impact on shares. This one was going to be 10 million on earnings. I remember that because it was a big number. Hey, 2 million on shares. This one was going to be 2 million times 72%. I presume that's the number. 2 million times 72, 1.44 million. It was also going to be 2 million shares. Yeah, 20. That one was a bit more work to work out, but it was also going to be 2 million. When we work out earnings per share for these, that one works out at 0, that one works out at 5 rand, that one works out at 72 cents. In order to decide which one I'm going to put in first, I'm going to put in the one that dilutes the most first. Which one is going to dilute the most? The one that's adding nothing, isn't it? That one's adding nothing to earnings per share. So this one ranks 1. Then from these two, which one is the one that is the lowest? This one. And then this one. That was what I said, hey, lowest earnings per share. Okay, sometimes we get that mixed up. Let me just double check. Lowest earnings per share first. Okay, so remember, I want the worst case scenario. I'm going to put in the one that's the worst first. And clearly, now the stupid thing moves. Clearly, you can see that the options will be the worst. Okay, it's not a lot of shares, but they're going to add nothing to profit and they're going to take shares, isn't it? Whereas the others will at least add something to profit. So once I've done that, once I've worked out which ones I'm going to do first, then I do my calc. Okay? And when I do my calc, I then do it in that order. So look at my order. Options, bonds, prefs. Options, bonds, prefs. So here's my order. Here's my calc then. I start with basic. You guys did the basic calc for yourselves last week, do you recall? I start with basic. Basic earnings, basic number of shares, earnings per share. 2.88 Rand. Okay, that's the calc you did last week. That's where you would start. That is always where we start with diluted, with basic. Then I put the options in first. No adjustment to earnings and a 25 adjustment to number of shares. I like to actually see it. I would see it with like a thing there that's got the 25 and a 0, and then those are my numbers for options. Okay, so there's my numbers for options. 11.5 and 4025. My earnings per share drops by a little bit because it was only going to be a few shares. Drops from 288 to 286. Am I diluting? Yes, I am. Okay, I carry on. Now I add, I think it was 1444, wasn't it? And I add 2 million on that side. Or was it 1440? 1440. Sorry, let me just rub out there so that I can actually see. So over here I added nothing and I added 25 for the options. and I got that. Then over here I added 144 and I added 2 million, and those are the numbers I have. I now do my dilution, big dilution, yeah. So I've gone from 288 to 286 after options to 215 after debentures. Now I do my prefs. Now my prefs are going to make this number go up by 10 whopping million to 22, and this number is only going to go up by 2 to 8. When I do my prefs, look what happens. My number's going up, isn't it? Is that maximum dilution now? That's the dilution if I put all my instruments in. But is that the maximum? No, what's the maximum? The 215 is the maximum, isn't it? So this one is anti-dilutive. So when I get anti-dilutive instruments, I ignore them. What are the chances that a preference shareholder who's getting 10 million rand is going to exchange his 10 million rand into 2 million shares where he's only getting 2.86 rand a share? Who in their right minds, isn't it? It's never going to happen. He's not going to do it. Okay, so when we see these ones that are anti-dilutive, they're actually adding to the earnings per share. Which crazy shareholder is going to convert his prefs into ordinary shares and make himself worse off to make the ordinary shareholders better off? Nobody, isn't it? So we ignore those, the anti-dilutives. And you can see that if we hadn't made that step story, if we had started with prefs perhaps, then the whole thing would have been screwy-looey, isn't it? If we had just put them all in, which I'm sure was your temptation when earlier I said to you, let's do the calcs, you would have just landed up on the 286, isn't it? Which is a 2-cent dilution, when actually the worst possible dilution is actually down to 2.15 rand. Okay, so unfortunately in an exam, they will almost always give you more than one dilutable instrument. Your steps are exactly what we've just done and what we've been doing all lecture, which is to work out my adjustments. Yes? Work out my adjustments for each one. Then, when I have more than one, I have to do a 2-step. I have to first work out the sequence of dilution. So for the two that you have options and prefs, so options and debentures. You're going to work out for options 0 and whatever. I think our number was 100,000. And then for your debentures, we had the 361 blah, and we had the 250. And you're going to work out the earnings per share for those two, and you're going to work out which one we're going to put in first. And then you're going to do your calc. This calc, I don't like so much. I prefer it the way I showed it to you, that it actually add on and you get the new total, and you add on and you get the new total. You'll see that they've done their add-ons over here. But just do it in the table. Start there and say options, put your numbers in and get new totals and work out a new one. Then put whichever one you have to do first. Okay? We can finish that assignment? No, not finish it, but finish that part B. So this is where we were. We had worked out our adjustments. You now need to do sequence, and then you need to do your final dilution table, and you need to check if there's any anti-dilution. I'm guessing probably not. And you have to start with the numbers from last week. Who has them handy, the numbers from last week? What were they? It's that number, 50688. Is it that number? Okay, so that's that number. Because there were no prefs or anything, hey? Yeah, and then the basic shares, we had a straight 19. Okay. With the zeros, right? Okay. All right, so that's where you're going to start, which is the numbers from last week. Okay, I'm going to give you a chance to try and do that. Because because we only had 2 and 1 was options. Options will always be the most dilutive because there's no profit. Hey? It's always a 0. 0 over anything is 0. The only worst case scenario would be if profit actually went down afterwards, but I don't see how that would happen now. If you had 2 with 0, you would pick obviously the one with the highest number of shares first. If you did have 2 with zeros. Although they both would dilute, so I don't think it would make a difference really. When is this assignment due? What does it say? I don't know. 24th of March. First question, is it a lessor or a lessee? It's a lessee. The straight lessee generates most of it. Oh no, it's a lessor. Mongomo generates energy, salt, environmental laws, cease natural gas explorations, lease out rock drilling machine. It's a lessor. Okay. Today's the 1st. 1 plus 7 is 8. Plus 7 is 8 plus 7 is 15. Plus 7 is 22. Okay. Might do lessors first. We don't want to finish an assignment on the 22nd and then have it due the 24th, a big written one. Or it's fine. Rather, think about it. Lessor, I prefer to do lessees first than lessors, but I guess it doesn't matter. You can do lessors first and then do lessees. Alright, so next week we're going to do, so we've so far done the second part of this question, right? The 16 marks. Calculate, it's just a calculation. Usually for earnings per share, it is just a calculation. If they had said disclose, you would do a statement of P&L and OCI, and you would at the bottom put basic and diluted with the comparatives, but in this case none as well. And then you would do the note. The note would start with that profit of 5068 and show the adjustment that we made for the interest saving to get to the diluted, and would start with the basic number of shares, the 1.9, and do the 2 adjustments to get us to the diluted. Yeah? Essentially, it's just a reconciliation. But usually they ask for calcs. So as long as you're very clear then at the end what your numbers are, usually what they'll do is, if it was me marking for 16 marks, I go check if you got your numbers right. If you do, Bob's your uncle, 16 marks, and I move on. If it's wrong, then I go back and check if you've got pieces right. Yeah? Okay. And then the rest of the question, part A, is transactions relating to a drilling machine. And what happened is Mongomo stopped drilling because of some environmental laws about drilling in rock, natural rock. And then they sold their drilling machine through a lease to another company. So they are the lessor. They are the ones giving the machine. So it's lessor accounting. And we, I suppose, can start with lessor and get lessor done, and then this question done in a couple of weeks. Next week, we're going to do dividends per share. We're going to do headline earnings per share, which I told you about in the first lecture, HEPS it's called. And then we're going to practice a past exam question paper. you can see from what we've done last week and this week, so many little moving bits, isn't it? So many little things to remember, horrible little things. And the truth of it is that in the exam, earnings per share can be few marks like this, sometimes less. And it takes so long to get it, isn't it? And like what we're doing tomorrow, next week, dividends per share, they hadn't asked it forever, amen. And then the one exam, that's all they asked was dividends per share. So like we can't leave out any bits, isn't it? Can't leave out any bits. So we will next week finish earnings per share. That'll be the 8th. Then the week after that, oh no, next week is the 8th. Then the week after that, we'll start leases. We will spend also 3 weeks on leases. But then we're more or less done. Yeah. Okay. We're finishing a bit early again. Yeah, these assignments throw me because there was an assignment in Mac. Oh, you were here. That budget. Oh, no, you weren't. Remember that budget assignment? Where I thought, oh, it's going to be quick to do. And then it took like almost the whole lesson. I never know how long the assignments are going to take to get done, isn't it? So I'm trying to get through the work and get to the assignment in time. But then if the assignment is fairly straightforward, then we get done quickly. But when we start doing past exam questions, that won't be the case. Yeah. Okay. Unfortunately, 25 minutes would also not cut it for earnings, headline earnings per share and dividends per share. So next week, headline earnings per share and dividends per share. You guys can go right out to the side.